a tremendous 9% of dividend, but down of more than 40% since the beginning of the year. Is Algonquin stock a value trap or an interesting pick to keep an eye on at the moment? This is the question that I'll be answering in this video, where I'll do a full stock analysis on AQN stock. I will start as always by describing what is the business model of the company, so how are they making their money and who are their different customers. Afterwards, I will make a full fundamental analysis with a price prediction from different valuation methods, and this will help me to see if the stock is currently under or overvalued. So now let's get to it right now. Algonquin is a Canadian company in the renewable and in the utility sector, which has been created in 1988. Its main fields are obviously the creation and the transportation of different energy, the water industry, the natural gas, and the electricity field. This company also decided to have a full net zero emission by 2050, which means that during the next couple of decades, they will make sure that they are using many different renewable energy for the future. It is why AQN at the moment is investing massively in different natural resources like hydroelectric dams, wind and solar power facilities, and utility businesses in the field of water, natural gas, and electricity. At the moment, the biggest part of their operations are located in North America, and it's why this company has recently acquired many different companies. For example, in 2019, they have acquired a Bermudian utility company in the field of electricity, but they've also decided to acquire a New York utility company in the field of water. And more recently, in 2021, they have acquired a Kentucky Power Corporation. So as you can see, they have a pretty wide exposure field. And despite their recent loss of many billion dollars in terms of valuation, this company still has a market cap of close to $7 billion at the moment. And they currently have more than 3,400 employees all around the globe with more than 1 million customer connections. Throughout their 2021 annual report, they have said to operate approximately about 1,500 wind turbines, more than 1.2 million of solar panels, and more than 55 hydroelectric generators. And as you see, the biggest part of their reported revenue came from the US, followed by the Bermuda, Chile, and Canada. And even if, as you can see, it is a Canadian company, it has still bought many different subsidiaries in the US recently, which has helped them to grab a massive market on that side. However, for the future, there will definitely be a massive need for the Canadian market, especially knowing that over here in Canada, which is the second largest country in terms of territory, we have multiple natural resources like the hydroelectricity that we could exploit in the near future for all the world. And with the threat of the global warming that is set to increase in the upcoming years, the Canadian government as well as other governments in the world have already set some different rules considering the gas emission. And this obviously will help all the different green renewable companies in the near future. Algonquin is also considered as a really good company in terms of their earning growth that has been massive over the last couple of years. And historically, this company has been able to keep a great 10% of annual growth rate in their dividend. This is a pretty good news for all the different dividend and income investors that are willing to receive some great dividends over the next years. And if you're willing to invest in a sector that is predicted to have some massive growth over the next couple of years, well, on that side, Algonquin could be a great pick to keep an eye on. But why is that stock has lost so much value over the last couple of weeks? Well, obviously, there are many different criteria that are impacting the current value of this company. The first one, obviously, being the market correction of more than 20% that we've seen since the beginning of the year. And obviously, this was kind of linked to the increase of the rates from the Fed to fight the high inflation, which means that all the people that have more debt will obviously need to pay more interest than previously. And in the case of Algonquin, as you'll be able to see in the fundamental analysis, they have currently way more debt compared to what is their cash position at the moment. And this is why they have seen a massive decrease of more than $195 million in their net income, and that despite the fact that in the third quarter of 2022, they have been able to increase their revenue of more than 26%. And add to that, obviously, you have all the different volatility that we've seen on the market recently. This company's situation was so bad that even the CEO has recently said in the last couple of days and has written a letter to the different shareholders where he has basically talked about the different problems that they have lived throughout the last couple of weeks. But they have also been able to reinforce their different position into this company, where they have bought back many hundreds of thousands of different shares of this company. And obviously, this massive buyback has sent a great and positive signing out to the different investors of this company, because that basically means that all the different chiefs of Algonquin consider that this company will have a great potential of growth in the upcoming years. But on your side, in valuation terms, let's see if this company is worth your money. Now in terms of valuation, we can see that this company worth a current $6.83 billion of valuation. However, with a super high price to earning ratio of about 107, which means that this company at the moment would pretty much be overvalued. Unfortunately, we can also see that this company doesn't really have a great profit and operating margin, as well as a negative return on equity, which is a pretty bad news for the different investors. The good news, however, is that over the last 12 months, they have been able to generate over $2 billion of revenue. And as I told you earlier, they have a great 26% of increase in their quarterly revenue growth for the last quarter of 2022. But unfortunately, as I told you also, this company is also having a lot of debt, about $7.79 billion of debt compared to only about $114 million of cash. And this makes that even if the current dividend yield is about 9.52% per year, their payout ratio is super high, even higher than 1,000%, which means that at the moment this dividend isn't really sustainable on the long term. And despite having less volatility compared to the market with a beta of about 0.35, AQN has still lost way more value compared to the average market, with a loss of about 42% over the last 52 weeks compared to about less 15% for the market. And as you can see, despite a great increase in their revenue over the last 3 years, the cost of their revenue and also the different operating expense have both been increasing, which has led them to have a pretty negative impact on their net income over the last 3 years. Unfortunately, their cash flow from operation have also been diminishing over the last 3 years, which has obviously impacted negatively their free cash flow that are massively negative. And now to see what is the current and what should be the real value of this kind of company, let's use first the Peter Lynch valuation method. Basically, you need to add the future growth of earnings per share to the dividend yield divided by the price to earning ratio, always knowing the fact that when you multiply the price to earning ratio with the earnings per share, you obtain the current price of the company. And with those hypotheses, we can see that the result were about 0.14, especially with this super high price to earning ratio. It means that this stock at the moment would be pretty much overvalued. For our dividend discounted model, unfortunately, since we can see that our average growth rate is higher than our weighted average cost of capital, it means that this model doesn't work in that case, and that we can see that our intrinsic value would be negative. And finally, the last model that I'll be using is the discounted cash flow model, where you basically find what is the real value of the company using the free cash flow of them, with also the discounted rate, which is the weighted average cost of capital, that you can find obviously with the cost of debt calculation, the cost of equity calculation, and at the end you obtain your final result, which is close to 5% at the moment. Unfortunately, what is the problem here is that our free cash flow, as we have saw earlier, are negative, meaning that once again this formula won't really work because our intrinsic value in that case would be negative as well. And so in both cases, as we can see with the discounted cash flow model and the dividend discounted model, this stock would be pretty much overvalued as well. So as you've been able to see in this video, even if the company is giving a great 9% of dividend per year to their investors, it isn't really the best company in terms of valuation because this company is not really profitable at the moment. So it would be considered as an overvalued stock mainly because it has some negative free cash flow at the moment, and also because it has a super high price to earning ratio. However, keep in mind that all those different financial metrics have their certain limitation to them, and they don't necessarily take in consideration, for example, the future growth that is predicted in this sector for this kind of company. I personally believe that what have been the news and the letter of the CEO recently also sent some great news for the different investors. On your side, if you're personally willing to invest and have a little bit more risk and that you're a dividend investor looking for the best company with the higher dividend, well, even if the dividend payout ratio of this company is quite high, it could be a great company considering that they have a great history of increasing their dividends over the last couple of years. But of course, until the fact that the green renewable sector will be the dominant sector in the energy field, you will have to take a little bit more risk compared to some oil company. However, if on your side you're looking to invest in the best potential of growth companies which are the largest in terms of valuation, well, check out this video over here that tell you why Meta is one of the best company that you could take a look at the moment. And if you like personal finance, make sure to join the Noor family by subscribing to the channel for only $0.0, and I will see you soon. Peace!